They say that in this life there are two realities, two certainties, death and taxes. So in this webinar, we're going to have a look at the various aspects of the Income Tax Act which will affect you as a private investor. Really, there are three things that you need to know about the Income Tax Act. The first one is called Securities Transfer Tax, and that is a tax of 0.25%, 0.25% of the value of your transaction, which you have to pay when you buy shares. When you sell shares, the guy who buys them from you, he pays that tax. The second thing that you have to understand is called capital gains tax, and that is somewhat more difficult. In South Africa, you have to pay tax on any net capital gain that you make during the tax year. If you buy an investment for R1,000 and then sell it for 1,100, you will have made a capital gain of R100. If you also made a loss of R100 on another investment, then you could set that loss off against your gain and you would pay nothing. So capital gains tax only applies to your net capital gain during any tax year. As an individual taxpayer, 1/3 of that net gain is added to your taxable income in the year when you realize the gain. In other words, when you sell out the share and make the gain. And that 1/3 is called the inclusion rate for private individual taxpayers. But what does taxable income mean? In South Africa, we have a sliding scale of tax, which means that people who have a higher monthly income pay a higher percentage tax, up to a maximum of 40% for people who earn over 617,000 Rand per annum. So if you earn a monthly salary of 51,417 Rand a month or more, you will be in this marginal tax bracket, and you will be paying 40 cents out of each Rand that you earn in tax. And that means that if you make a net capital gain of 100 Rand on your investments during the tax year, you will have to pay 40% of that inclusion rate of 33% on your capital gain, which is 13.33 Rand out of the 100 Rand capital gain. Obviously, if you earn a lower tax bracket, in other words, if you earn less than 51,417 Rand a month, then you will pay a lower rate. Let us summarize this with an example. Let us suppose, for example, that you have bought shares worth 20,000 Rand in the stock market. And then later on, you sell those shares for 30,000 Rand. That means that you have made a capital gain of 10,000 Rand. Now, with the Income Tax Act rules, 33.3% of that, or 3,333 Rand, will be added to your taxable income in the year when you sold the shares. That is your inclusion rate, 1/3. If you had a taxable income above 617,000 Rand per annum, then you would have to pay 40% of that 3,333 Rand in tax, in capital gains tax, and that comes to 1,333 Rand. On the other hand, if your taxable income was only 240,000 Rand per annum, or 20,000 Rand a month, then you would only have to pay 25% of that capital gain of 3,333, which would come to 833 Rand. Now let us consider the position with companies and trusts. Some people invest on the Johannesburg Stock Exchange through a company or through a trust, like a family trust. And these organizations, these juristic persons, have a different inclusion rate in terms of the Income Tax Act. So whereas a private individual's inclusion rate is 33.33%, or 1/3, a company or a trust has an inclusion rate of 2/3. So let's go back to our example. Let's suppose that you bought your shares through a company and you made a 10,000 Rand capital gain. Then 2/3 of that capital gain, or 6,666 Rand, would be added to the taxable income of that company during the tax year when that capital gain was made. But of course, in a company, the tax rate is 28%, so you would end up paying 28% of that 6,666 Rand, or 1,866 Rand in capital gains tax. Trusts, on the other hand, are taxed at the rate of 40%. So if you were buying the shares through a trust, you would have to pay 40% of that 66% in tax. And that would work out to 2,666 Rand. The final aspect of the Income Tax Act that you need to concern yourself with if you are a private investor is the whole question of being declared to be a share dealer by the taxman. If you buy and sell shares regularly and quickly, and especially if you do not take dividends on those transactions, then the receiver may decide to declare you to be a share dealer. What he is saying is that buying and selling shares is your business in effect, and he will therefore seek to tax you on that business. And so he will add 100% of your net capital gain in any tax year to your taxable income. Obviously, this will have an enormous effect on your profits, because if you make a capital gain of 10,000 Rand, he will seek to add that entire 10,000 Rand to your taxable income. So if you're in that marginal tax bracket, you will pay 40% of that 10,000 Rand in capital gains tax, or 4,000 Rand. There is one aspect of this which is to your benefit, however. If you hold those shares for more than 3 years, then the receiver of revenue has told us you will not be taxed on the basis of being a share dealer. You will be taxed on capital gains basis. So, when you buy a share, you must look at it and decide whether you can hold that share for 3 years. You must say to yourself, where will this company be in 3 years' time? Because if you sell it before that 3-year deadline, you may well be declared to be a share dealer, especially if the transaction has been highly profitable. Of course, you can never pay any capital gains tax or any other tax if you hold the shares indefinitely. Then you will simply receive dividend income, and those dividends are subject to a withholding tax. The company that pays the dividends withholds 15%, and you get the balance. And that is the only tax you will ever pay.